This is a game changer, guys. Stackers, listen, because this is a hugely important moment. Maybe you're thinking of waiting. Just listen this through and then make a decision. And let's start with this really high-level view of the changes we've been tracking in the paper to physical unwind. As we've been outlining under the covers, Basel III NSFRs, the net stable funding ratios, changed the game forever. So it is simply means that the paper market had to start waking up to back up their positions. And it uncovering the fact that liquidity providers making markets in them 10 times larger than the COMEX spot foreign exchange gold markets, which are the key markets. Those are the deliverable ones. It turned out they would have to, for the first time in 50 years, begin backing up what they had was placed on offer with physical. It became patently clear that the paper market jig was coming to a close. But it would take until Basel III NSFRs to be fully implemented in order for the paper sham to be forced to compete with an increasingly global physical marketplace. And as we see now, the ring-fenced COMEX is coming into the crosshairs for loadout. Loadout meaning somebody's backed up to the warehouse door and said, "Give it to me, baby." And then they were loading out their paper positions into physical. Well, I mean, the scramble to fix the March 2020 paper market implosion planted the seeds for Basel III legislation. And so when you see those kind of spreads between the cash market and the COMEX, it reached a point where the paper market really broke forever. And while the central banks were able to put a band-aid over this, what is a gaping wound, it had to be permanently fixed. And there was only one way to fix it, to begin the process to force liquidity providers to back up what was on offer with physical bullion. So this siloed world of the CME and the LBMA, this ring-fenced world, actually had been breached for the first time. And global physical buyers turned upon the market makers, calling them for physical delivery. But just to sum it up, if the Western central banks had not stepped in to bail out the too big to fail fractional reserve bullion banks who treated bullion as if it was cash in the bank, if they hadn't stepped in to bail them out in March 2020, and we were talking about 200 million for Goldman, we were talking hundreds of millions. And in fact, we were talking about the second tier banks saying, "I don't want any part of this anymore," and bailing. We had quite a few second tier Swiss banks saying, "Not making markets in this anymore. We're exiting this space. We'll just look after our clients." So, I mean, this is a daisy chain of taxpayer insured banks that would have imploded. You just need one to fail, the lot fail. When you've got physical attached to one side, a deliverable physical aside to one side of that cross, which separates gold and silver. I know platinum and palladium, but gold and silver primarily from every single other commodity. And the problem lays in the fact that a spot foreign exchange gold or silver contract is physically deliverable against the resulting dollar price that pops out the other end. There's the situation. Add in a little magic dust, such as creating a positive lease spread to incentivize central banks. Hey, let's take some paper gold. Let's take our physical gold and let's lend it out. Oh yeah, and then we can do that and we can lend it out in sufficient size to meet any real physical demand, because we've got leverage against unleveraged. So we can just swamp this price and then, yeah, so what? Well, we had Rubin in 1998 coming out and offering 10% spread on bonds. So yeah, why not? Gold was producing nothing. So take all your gold, sell it into the marketplace, just get it gone, take the yield, invest it in the stock market. And so what do we have? We have this accruing massive paper short position. However, on March 2020, this gold convertibility window was smashed open, and while it's not been realized yet by the siloed speculative traders confined to the COMEX, Anyone with a view into the wholesale markets knows this window is open and is actively being pillaged by competing BRIC central banks primarily, which is precisely the reason the central bank of all central banks, the Bank of International Settlements, began to unwind these leases, forcing them to buy them back from the agent banks that they'd laid them on the books for. Now, until Basel III NSFR regulations, which came into force on the 1st of January of this year, every single central bank began to position to revalue their physical reserves higher from the 50% haircut they were getting to a fully cash exchangeable asset. Now, revaluing gold will enable central banks to be able to pay off massive swathes of debt. Now, this is the longer term plan, not just from a cash asset perspective, but also it would behoove central banks to be on the long side of gold ahead of this inevitable revaluation. And this is exactly what the BIS footprints just revealed. And this is why it's important that we look at this now, because really, are we wanting to defer this game any longer? Now, given the sheer pace, and I'm not suggesting you go out and borrow money to buy gold and silver, but you stackers out there, really, if you've got any sideline money here between now and the end of the year, I think to me, that would be probably a wise choice. Make up your own minds. So while it's not being recognized by the spec short sellers, naked shorting gold and silver against a rising dollar with no view into the real world, all the house insiders are long against them, not just in the synthetic markets, but for their own books. And the March 2020 situation was the single historic event that has accelerated the inevitable gold price reset, bringing the gold price revaluation forward to this year, setting the stage for 2023. It's no coincidence that we can now circle back to the all-important effect Basel III is having. I mean, why it's yet unseen, but it will be the impetus for the resident COMEX frogs to jump out of the pot before year end, leaving the unwitting speculator tadpoles to boil. Now, this is derivative exposure to gold that's on their books. Undeliverable delivery exposure without buying back these bets. However, as we've been tracking over the course of the last 10 months, their footprints have evidenced their gold desk stealthily calling in decades of accrued paper gold liabilities, all of which have been laid on the balance sheet of their agent LBMA banks, who have privileged to have gold accounts with the Bank of England.